Alrighty, so a super quick recap of what we were just looking at in the previous lesson, which is essentially whether you have inducement to the left, so if you have leg inducement, or whether you have inducement built to the right in the pullback. Pullback inducement depends on what scenario you're going to be looking for. So generally for scenarios, if you have neither, then where's the liquidity? It's probably going to be the POI and the low itself, okay? So we wait for that to get broken, and then you can either do nothing or try and trade the sweep, which we'll get into in a bit. If there is leg inducement, okay, then the POI that has the leg inducement right in front of it, so it needs to be nearby, has an increased probability of now holding. You might not want to wait for pullback inducement to be built, right? It may not be required because it can use this here. If there isn't any leg inducement, so there's nothing on the left, then what do? We wait for something to be built on the right. Otherwise, if it doesn't, you're back in this scenario and it's likely the low and the POI is going to fail, okay? And if you have both, then happy days, should be a pretty decent probability that you'll get at least a tradable reaction from the POI, okay? So if there's nothing on the left, wait for it to be built on the right, otherwise the low is going to go. That's the simplest way to think about it. So now, if we start to dive into these entry models, okay, again, this is where we can get very lost in the source and it can get very technical, which I appreciate, but I want to keep bringing us back to the general idea. And if you can think about, if you think of like a decision tree, so if you've got like, you start with decision one at the top and it's like yes or no, right? And then it turns into like another one or another one there, and then it's like yes or no. I'm finding this hard to draw really quickly, but essentially, right, then you're going to have like loads and loads of decisions, and then it turns into like, just, this is so poorly drawn, but you guys know it's going to turn into like a super complicated like trade plan that you have to work your way through, and that's essentially what a trade plan ends up being. Okay, you start off with the first thing you look at, market structure, we bullish or bearish, then you look at in the premium and discount, and then it just turns into all of these things that you work your way through. Okay, so when you're first trying to learn something, like you're going through the course and you're thinking about the stuff and you see all of this, that's because we're building out this massive thing. But actually what will happen when you get there and you get competent and you reach that fourth stage of unconscious competence that we spoke about at the start of the course, that's when you literally just look at your chart and it's just like bang, 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 right? It's the same way you jump in your car if you drive. You're not thinking like, oh, I need to do this and that and put my hand there and then check that mirror and then that mirror and then I do this and then I put my foot down on the clutch and then I change the gear into there and then I have to do like you just get in and you listen to tunes and you're chatting to your mate and you're driving away. You're not like thinking about all of the things that you're doing. Okay, so don't be overwhelmed by all of this. I'm going to do my best to go through all of it because we need to be comprehensive and we're going to get stuck into the detail, but then I'm going to at the end zoom all out again and help simplify it for you for the easiest way to think about things and what to concentrate on kind of at the start of your journey. And then you can bring in the more complicated stuff as and when you need to, if you want to, okay? I'm going to do my best to simplify things for you. But first, let's kind of, jump into the details as we go. Okay, so there's my little rant on that. Now, actually, what I will say is, back when we had this scenario and we're thinking about the higher time frame inducement, whether it's on the left or the right, and kind of got those four scenarios, it's kind of an even slightly simpler way to think about it. Like when you're in a live market, it's kind of really only two scenarios. There either is leg inducement, here, there isn't leg inducement, or there isn't. Okay, so this thick line is your higher time frame. Okay, so let's start with the scenario in which the POI you're looking at on your higher time frame, okay, so whether it's like, the 4 hour, let's say, or the M15, if there is inducement on the leg inducement, okay, we know that's a pretty, a good tick in the box, it's a good positive confidence for this POI to hold on this time frame, right? So in that scenario, if we have inducement, like I said back here, right, this is the scenario, you may not need to wait for pullback inducement, okay? Some of you might always want both, but this is just a scenario in which you might not need to wait, okay? So that's kind of the liquidity entry model one that we can look at. And basically what this is saying is when price is coming down on your higher time frame, right? Let's say you're a day trader, kind of like how I currently trade, I'd be looking at this as an M15 zone, okay? So when price then takes that M15 low there and uses the available strong liquidity below that low, then I jump down to the M1, my execution time frame, and I look for my M1 entry model, okay? So the thin line is your time frame. Let's say you're more of a swing trader, right? You're going to be looking at this as your 4 hour time frame, right? That's a 4 hour low. Here's your 4 hour POI. When price comes in and takes that 4 hour liquidity below that low, the strong liquidity below that low, you then jump down to the M15, okay? And this becomes your M15 time frame, if you want to think about it that way, okay? So as we can see here, this is your lower time frame execution. That line there, liquidity, can you hopefully visualize what that is? That's price coming and taking the liquidity below that low, the available strong liquidity below that low. So once that liquidity is taken, and now you're looking at this POI to trade from on your lower time frame, this being the higher time frame POI, okay? Now, what you can, one entry model you may want to have is that you just wait for the flip, okay? So you wait for structures to shift in your favor on that time frame, and now you can take the flip, okay? Because what will often happen is you'll have multiple POIs, and this is what we call the extreme, the one at the extreme low, and this is like your decisional flip. And the question can be, well, which one do I take? There's two POIs. So what we're generally saying here with this entry model is if liquidity has been taken, then take the flip. Take where the supply and demand interaction occurs, okay? And that's kind of the general rule that we're going to go with here. Okay, so price sweeps the structural low, liquidity has been taken, now I wait for the flip, and then we can get involved, okay? That's the general idea, right? So higher time frame leg inducement, that's kind of the name I've given it, if it helps you remember it. So ideally as well, what I love to see is when you get the supply that caused that liquidation, right, of this low here, when price moves up and takes that supply out, now you can see that demand is now in control again, okay? Because this is where you've got that last significant injection of supply that caused the liquidation of the low. If you then get your higher time frame mitigation and then you flip the supply that caused that liquidation, now this becomes a very decent level to potentially get involved, okay? So the general idea again about this model is inducement to the left, the liquidity gets taken there. So now you don't need to see any more liquidity built and taken because it's been taken here. The BFIs, let's say, big money then uses the liquidity below that low to enter their positions. They then flip the supply that caused the liquidation. Okay, so now we can follow the money and we can get in on the demand that caused it to take control again, right? And that's where we look to get involved. So you may not need the flip to sweep liquidity because the liquidity has been taken here. So now we can just look to get involved, okay? That's the general idea. So again, I'm going to caveat all of these entry models. There's so many ways you can skin a cat here. You could have the flip that sweeps, you could have it doesn't. These entry models are kind of showing the bare minimum, let's say. So the point I'm trying to make here is if you have a flip that sweeps liquidity, does that mean that you can't then take it? No, of course not, because that would be, let's say, even more high probability. What this is saying is that because the liquidity has been taken here, and then you get the flip, you can take a flip that doesn't sweep because the liquidity was used here, okay? So that's the scenario in which you have the inducement. Now, all of these are going to be scenarios in which you don't have inducement here. So that's not to mean that if you have this, that you can't use one of these models because it would make it even higher probability. It's just that when we don't have inducement here, what do we need? We want to see inducement built here. And these are all the entry models or scenarios in which inducement can be built on the right, okay? Because here, obviously, this is the pullback. No, there's no inducement built here. Nothing. It's just price just comes down, all right? And then price goes up. There's no liquidity taken on the pullback. No pullback inducement is built. Why? Well, because we took it on the left. That's why we didn't need it, okay? So that's what you can use an entry model like this when there's inducement on the left. All of these are how liquidity can be built to the right, okay? That's what these entry models are. So if you've got a straight push and no inducement, and you think that your POI itself could be induced, right? It could be broken. Then this is where you're going to wait for what? You're going to wait for the pullback inducement. And these are the scenarios, okay? So strong liquidation is probably my favorite and what I would recommend the majority of you just kind of keep your main focus on and almost always wait for this because generally this is when I find it typically has the highest strike rate, okay? So there's sorts of two variations of this entry model and I personally categorize, at least at the time of recording, I personally categorize them as the same. Okay, now you may want to collect separate stats and call it like EM2A and EM2B if you want. But basically, whenever you hear me in the future talk about strong liquidation on the entry model, these are the two scenarios I'm talking about. And it could be, I view them both as the same at the moment, okay? So, no inducement, price pulls back into our higher time frame POI. Let's talk about it as if we're an M15 trader, that may help, okay? So we come into our 4-hour POI, we jump down to the M15, okay? Once our 4-hour POI has been mitigated. So now we're looking at our entry model and we ask ourselves, was there any inducement in the leg to the left? No. Okay, so I need to see liquidity built and swept here. So what do we have on the M15? Price pulls back, it comes down and it breaks that high. What does that do? It generates liquidity below that low. Okay, so that becomes a strong low on the M15. So now when price comes down and liquidates that low into our POI, what do we have? We have available strong liquidity below that low that big money can now use to buy against into their positions. And then ideally, we see the supply that caused the liquidation get flipped, and now you can look to get involved. Okay? So you don't necessarily need to wait for a flip that sweeps liquidity here. Why? Because the liquidity was used here and now we're just getting in, okay? So this is what we call a fake break, or sometimes you hear people say a fake chalk. I think fake break's a bit more accurate because obviously, you know, if you've got like an M15 IBOS or a boss, well then this is going to be an even stronger low, right? The stronger this piece of structure here is that's broken, arguably the more sell side liquidity that is then generated below that low, right? Rather than just like a little chalk. If you've got, you know, a clear shift in order flow, that bullish shift, and then price comes down, right, that's going to be a much stronger liquidation. So that's version A of a strong liquidation, which is when you get that fake break, enticing early buyers into the market, right, who are getting long here, buying this low. They then get liquidated, right? So that inducement generates the sell side liquidity below here. Big money then uses that sell side liquidity to buy against. As soon as we get that liquidation, right, now we can look to get involved. This is basically the exact same scenario, except rather than having a strong low that broke structure, we just have very obvious equals, okay? So this one can be a little bit more subjective. Like, what do you deem to be significant equals? Like, do you want to see something really obvious, like really far apart? Do you want to see two little movements? And this is going to be down to you, right? This can get a little bit more subjective. So you will get this with time and experience as you see more and more examples. But generally, you want to ask yourself, you know, how it's pretty obvious. And obviously, the bigger it is and the more obvious it is, the better ideally it's going to be, because there should be even more liquidity generated below those lows, okay? But whenever you hear me say, okay, I'm going to wait for a strong liquidation on my entry time frame, I'm basically waiting for either equals or a strong piece of structure to be swept. As soon as that liquidation happens, right, and then I'm just looking for that first flip. That's it, okay? I don't need to see the flip sweep. If it does, happy days, but I'm just happy to get involved, right? Now again, not 100% foolproof. Sometimes it's going to come down to here, it's going to come down to here, and then you may want to look for another entry, or like, you know, there's going to be other entries that you can look for. It's not always just going to work picture perfect like this, where price just comes in and does this, okay? This is just saying that in this scenario, once you've seen that liquidation and then you see that first flip, then you can get involved, right? If you want to. What I'm giving you here, I'm not giving you the secret sauce to the market. This is not the secret keys. What this is this is giving you what to do in each scenario. So you go, okay, if I see the scenario, I know I can take the flip. Rather than going, do I take the extreme? Do I take the flip? Do I take both? Do I wait for more? You just go, well, I use this entry model, okay? Over time, if you find that it doesn't work for you, or you find there's a better way, you know, you tweak it, okay? But this is your starting point. This is what you can use, and then you go from there, okay? Okay, entry model 3. So again, all the same scenario in the higher time frames, right? No inducement, so we're waiting for inducement to generate liquidity, to get that liquidation in the pullback, and then we can look to get involved. So these scenarios are where there is no strong liquidation, okay, in the pullback. So price comes in, it pulls back, and it comes in, and then we get the mitigation. So at this point, right, you're in your higher time frame POI, and then we get the break. So now you've got demand to buy from. This is where you need to keep asking yourself, where is the liquidity? Has there been a liquidation, right? Who has been induced? And at this moment here, has there been any liquidation? Well, if we look to the left on the higher time frames, no, because we know there was nothing here. If we look here on the pullback, has there been any liquidation? That is not a liquidation, a strong liquidation, right? Because it's a weak low. It didn't break anything, okay? So for these entry models, I need to see a strong liquidation, okay? And that's nothing, that's not a liquidation. So now when you get the break, the chalk or whatever, right, chalk or bust, but you get the break to the upside, and now you've got like a flip to trade from, or you've got the extreme zone, you've got 2 zones to pick from, so maybe sometimes 3. You have to ask yourself, has liquidity been taken? Was there available liquidity for big money to get involved? Well, that wasn't a liquidation. The flip didn't sweep any liquidity, so nothing's happened yet. So now what you can wait for is you can wait for the flip to be induced, and that can become the liquidity that gets liquidated. So this is where you'll see price come in, hit your higher time frame POI, you get your chalk, you get your flip, and then you get long and you buy, and then you get stopped out. That's because you have become induced. You are the liquidity, right? Then we come into the extreme. Now, this isn't going to be perfect either, because this could be just be the start of the strong liquidation model, right? This section here. And this could then use that low, right? That broke the high like it did here. And then we could get this entry model, right? So then you've liquidated that low, and then we get the flip like we do here, okay? So at this point, this is where I circled it and just say, wait to see if that holds. So you wait for confirmation, okay? And then like I said back here, ideally what you want to see is the supply that caused the liquidation, right? The supply that caused liquidation, ideally that gets flipped, and then you can see demand take control again. And then that's a really good entry model when you see that. Okay, so I'll go over that again. Both scenarios here, we get the strong liquidation, right? Before we get, the chalk that we're looking to get involved in. Here, when the break happens and you're looking at either buying from this demand zone here, the flip zone, or the extreme, you have to ask yourself, has there been any liquidity taken? Nothing on the higher time frame, no strong liquidation here, the flip didn't sweep, so there's been no liquidation yet, right? There's been nowhere where you can put your little X for liquidation. So you just wait, you be patient, and you either see, is this gonna happen, right? Where the low just breaks like that, and then we're back to here, but then we've got a strong liquidation, or you see, is the extreme gonna hold? And then look for the flip to occur, right? So you're basically playing what we call a confirmation entry off the extreme. You look to see if it will hold. Now, some of you might not want to wait for this, and you might want to be a bit more, let's say, risky, more aggressive, and you may just want to get in here, okay? And you can have that as another variation of this, where you don't want to wait to see if it holds. You go, that's enough for me. I've seen the flip induced, right? Flip inducement, and you're going to get involved. And you can totally do that, okay? So again, what I'll say with all of these is, and this will come with time and experience, but it's all about the higher time frame idea. Okay, so I probably should have started with that. The whole idea with trading is not to have this picture perfect, super duper entry model that, it's kind of like intellectual masturbation. You find like all of these nuances and you could have the most amazing entry model set up in the market. Some of you will have experienced this so many times, and it just fails. And 9 times out of 10, it's because of this. You need to build the higher time frame narrative. Right? The multi-time frame analysis. Where are we in structure? Are we with or against the swing and the internal? Are we well priced? Have there been sweeps of liquidity? What's going on? That's the hard time frame narrative, building the whole story and picking the right hard time frame POI. If you just trade this in the middle of nowhere, trying to buy at the highs or whatever into supply, you're more likely going to get smashed. Whereas you could be buying from the strong low down here, and you could take, the most simple entry model, which would just be a chalk and then enter and then get long, right? None of this fancy stuff. But because you did it in the right area, you have a much higher chance of it working out. Okay, so you want to be doing all of the hard work on the higher timeframes. And then, I don't want to say this becomes less important, but it kind of does in a way. You can be more aggressive with your entry models because you're just trying to get in. You're using the lower timeframes as a timing mechanism and a refinement to try and get in here, right? The hard work is done on building the hard timeframe story in POI, right? This is something that seems to go, it's an obvious point when you hear me saying, going, yeah, but it goes over so many people's head. And when you're live in the market, I get it, because I'm victim of it all the time. You're watching your markets, you're watching the M1, you're watching M15, whatever your time frame is, and you see this picture perfect entry model that you know inside out, and it sets up, but you're doing it in the wrong area when you take a loss a lot of the time, okay? So if you're, let's say, you just love the area, like it's a strong swing low, there's tons of risk rewards, everything's aligned, you want to get involved, then yeah, maybe then you want to be a bit more aggressive and you're happy to not wait for the extreme to hold first. Maybe you're not so sure and you're buying like on a POI up here and it's not well priced and we think we could come lower, then yeah, maybe that's when you want to wait for this to hold and then you look for this one, okay? So that's flip inducement. That's when there's no liquidity taken to the left, no liquidity taken to the right. So you don't want to be trading from the flip or the extreme yet. You want to wait for something to be taken. That then gets induced. Let's see if it holds. Then you've got the flip that causes liquidation and boom, then you're off to the races, right? Sweet. This one, higher time frame leg POI sweep. Couldn't think of a better name, so this is what I come up with. And this is essentially where there's no inducement to the left, nothing builds to the right. So remember I was saying there's no inducement to the left and nothing's built to the right, and you want to trade from here, what do? Just wait and see what happens. Wait and see if anything does get built, like you get one of these entry models here, or just wait and see if the low itself goes. And that's what this is. So this is your hard time frame POI, right? And this is price coming in, no liquidity is built, so don't get involved. Then the low goes, okay? So this is where price was down here, just down here, okay? That's what this entry model will be. And what you want to see is almost straight away, you want to see price aggressively, it's like a sweep of the low, right? Remember, you want to almost get like that, like a sweep of the low. You want to see price come in. And what you want to see is the supply here that caused that liquidation, right? You want to see that get flipped, okay? You have a much higher probability if you wait for that to be flipped because then you're showing demand regaining control that caused that break there, okay? So this one's a bit more of an advanced setup because really you're not trading the demand zone because the demand zone has failed at that point. So what you're trading is a sweep of the low, okay? And these are a bit, I don't want to say riskier, but they're a bit more advanced. So until you're getting consistent, I would concentrate on just trading when the zones hold, but this is something that you can have in your ammo for potentially in the future, okay? Where price sweeps, and in terms of targets, again, that will depend on the scenario because sometimes we've now switched bearish. It's just a bit of a pullback before going lower. Sometimes it does that, okay? So that will come again with depending on the overall picture. But that's the entry model. So if nothing's here, wait for it to go, and then you can look to trade this if you want. You don't have to. These are just, it's another tool you can now use. And then lastly, we have sweep flips. So again, you could remember hopefully you've watched the sweep flip lesson. There's, quite a few different scenarios in which a flip could sweep. So I've just put a few here. That's essentially what you're waiting for. No inducement to the left, price comes in, there's been no strong liquidation here, right? It's just a pullback. So we don't have a sweep of a strong low or equals, it's just price coming down, right? It's a weak low, there's no liquidation there, that low did not achieve anything, so that's not a strong liquidation. Okay, so when you're here and price is moving up, and then we get the break, and you're going, right now I want to get long because we've had supply fail and we've had structure shift, and you've got what? You've got the flip or you've got the extreme. You have to ask yourself, has liquidity been taken? Because remember, when we're back here, what do we have? No liquidation here, that's a weak low. Price mitigates our POI. We come in, we react, and we push up. So now you have a flip. So if price is up here, that's the same scenario as here, right? And you're looking, do I get long now? Do I buy the flip, or do I buy the extreme, or do I do nothing? They're kind of your three options. But here, let's come back. When we're here, what do we have? We've had no liquidation because that wasn't a liquidation and the flip didn't sweep. So that's why we wait and we don't buy the flip. We wait for that to get liquidated and induced. Whereas here, when we're here, no strong liquidation, but the flip has swept some liquidity, right? Whether it's the sweep of that sort of weak internal low, the sweep of the reaction, or the sweep of something in the previous leg, right? At least some liquidity has been taken. So this is where you may want to then just enter on the flip without waiting for a strong liquidation, okay? And again, I'm not saying that this is the perfect thing you should do. And if there's no inducement to the left when we get here, if there's a flip that's swept, that you should definitely take it. What I'm giving you is a mechanical tool that you may want to use, okay? Because what I was saying at the start is this is my favorite. Ideally, and this is what I would say the majority of you should just wait for. Always, if there's no inducement specifically, and even if there is, you still might want to wait for this. Wait for an entry model like this. Wait for that strong liquidation, okay? Now, you might miss some moves where this doesn't happen and it goes without you, fine. But it's going to increase your strike rate, okay? Now, some of you might want to add in this where you don't wait for the strong liquidation, and as long as the flip is swept, maybe you're happy to get involved, okay? These are just things you can use. I'm not saying that you should use them. So don't just see a POI that has no leg inducement and then see this and go, right, I'm going to take that because Matt said it always works. Not the case, right? I'm giving you a framework. So obviously something like this is a bit more aggressive than this because here you've waited for a true strong liquidation, whereas here all we have is a flip that swept. So this is what might be what you want to sort of save for like a POI in which you've built the story and a scenario just in which you just really want to get involved. And if you see this happen, you go, well, do you know what? That's enough of a liquidation. I want to get in. Whereas if it's like a POI up here, like I said earlier, and it's not as well priced and you think we could come lower, then maybe this isn't enough for you and this is where you want to wait for like an actual strong liquidation, okay? So for the majority of you, this would be my recommendation, at least what you start with, okay? Then you may want to add in something like this where you got a bit more confirmation, or some of you may just want to go straight into flips that sweep, okay? But yeah, so that's all of it. Again, it can seem quite a lot. A way to kind of simplify it in your mind, again, is if you're looking at your higher time frame POI, which is what you're looking at first, you're never just sitting on the lower time frames waiting for these models to set up. Because if you do that, you will see them constantly and everywhere, and you will take trades that are nothing to do with the higher time frame idea. This always comes first. Then once price is down here, then you look at this. Problem is people have their low time frame execution, time frame open all the time, and they see the setup because it will happen constantly, and then they think, oh, there's my model, I must get in. No, don't do that. Quick way to lose a lot of money, okay? Cool. So once you get to your higher time frame POI, first question regarding liquidity then becomes, is there any available liquidity that has now been swept? Okay, in this scenario, yes. So then if you've got that liquidation right there, then you can look for the flip and get involved. Ideally, that flip supply that caused the liquidation, right? Happy days. Here, no liquidity to the left. Okay, so ideally in this scenario, what I would recommend is you wait for a strong liquidation. Okay, so either a sweep of a strong low, right? It broke structure, and then look for that to get flipped, and then you're in, or the equals, same thing, right? That's always gonna be most ideal. For some of you, regardless of if there's an inducement here or not, I would just say always wait for this. It will help you out a lot. Next one is we don't get any strong liquidation. There's nothing to the left. So when we get here, has any liquidity been taken? No. So wait for the flip to be induced, and then you can be aggressive and just set your limit on the extreme, or wait for that to at least hold and wait for a bit more, and then you can get in here, right? This one is where no liquidity here. You're waiting and waiting and nothing gets built. We just keep moving to the downside. No liquidation happens. Then the low gets swept. And then if you see that aggressive move back in and we take out the supply that caused that liquidation and caused that break, then you can look here for that movement. And then lastly, again, no liquidation, nothing in the pullback, but the flip sweeps. Perhaps that's enough for you and you may want to get involved. But I'm going to keep saying this again and again and again until it sticks. It's all about the hard time frame narrative and POI selection. That is what comes first every single time. The perfect lower time frame entry model in the wrong higher time frame area is worthless. Okay. Here's another little thing that may help you. If your plan is something like this, you want to maybe just summarize it in your head with like one little line. Again, I'm not saying this should be the answer. I'm not saying this is what your trade plan should say. This is just an example of how you could maybe simplify it in your mind. So you don't have to try and think of all of this and literally just be like, is there available hard time frame liquidity to the left? Right, so once price is in your POI, you just kind of say this to yourself. Is anything to the left? No. Okay. Or if there is, sorry, when we're here, then once that liquidity has been taken, right, then you can take the flip. If there isn't, then you're in one of these scenarios, right? And so you can go wait for the strong liquidity to be built and swept to the right and then look to take the flip, right? It's kind of just another way of simplifying it. But I'm going to really stress that I'm not saying you should do this. It's just one way of building a mechanical framework so you know in each scenario what you're going to wait for. And you're not thinking, well, there's no inducement this time. Last time it kind of played out. Should I just get involved on the chock and flip? Do I take the extreme? You go, no, I've got my map. I know exactly what I need to wait for. And this is what I'm going to do. You've tested it. You collected your examples and your case studies and you know over X amount of time, this is what you want to do in this scenario. That's how you become consistent, because you have consistent actions, not because you found the most perfect entry model in the world, right? Cool. Now, I'll just end it with this before we go and look at some kind of real examples on the charts, but I just made the exact same that we were looking at here, okay, but I've just put it into a bit of a more zoomed in scenario without the high time frames. So this first entry model is the one where you have high time frame inducement. So that's this, okay? That's this here in the top left. And then all of the rest of them, so all of this, and this, that is when there is no inducement to the left, okay? And I've just done some more sort of detailed notes here for you. I remember with entry model 3, so when we were back here, when I was saying like you could get in, you could get in long maybe on the extreme. I've just put that in here for you, okay? So that would be down here. The top one here. Well, this would be where you would get involved before it. This is more where you wait for that to hold, you show that it's being respected, and then you get involved, okay? So hopefully this can kind of help you. I would highly recommend that you create your own ones because it will really help you to cement the idea of actually what's going on. And these green circles here, that's again to help you to show that you don't do anything until the liquidation has happened. So essentially, if I can summarize it, until you see one of those green dots, you shouldn't be thinking about an entry. Once you've seen the green dot, that means the liquidation has happened, the strong liquidation has happened. And once that happens, from that movement, the entry should occur, okay? What you shouldn't see is the liquidation happen, price come in, and then it goes down again, and then you get a chock. Okay, because the liquidity has now been used and it failed to do its job. So if the liquidity has been used and then it doesn't give you the entry and then we come down again, you don't want to be trading here because there's no liquidation now. It needs to build and sweep new liquidity. Okay, that can be a rule that can help you if you find it's not 100% foolproof. Sometimes you might it can play out and it can go, but generally what you want to see is the liquidation occurs, then we go straight away. That's when you want to get involved. Cool. Let's go look at some examples and see if we can cement this with